This week we're reviewing the Allan Gray Equity Fund. Cobie, I know you're going to take this, but 27 billion rand fund. Quite a big fund that we're looking at today.
This fund's been in existence since 1998, so kind of October 1998. So obviously when it started, it was far smaller than it is now. I'd probably dare say that this is one of the largest funds that we've got in South Africa. 27 billion certainly is a very, very large fund to run, especially if you're a stock picker and you're trying to, you're trying to pick stocks on a daily basis. We're looking at data here up to the end of May 2011. You'll see the managers here is Allan Gray. There's a team approach at Allan Gray, so there's a range of people that look after this fund. Just looking at returns, just period-specific returns over 12 months is underperformance 21.7 versus 23.2. 24 months underperformance again 20% per annum versus 22.6. Over 3 years, and that obviously includes the crisis that we had, 7.3 versus 3.6 per annum, and then
so
over
in other words, yes, the fund outperforming.
Yeah, absolutely. That's outperforming. And then over 5 years, very similar to the benchmark, 13.7% per annum versus 12.6% per annum. And then look, Eleni, look at the total expense ratio. It's fairly hefty at 2.1%. If we look now at the fund, and again we're looking at the rolling returns for this fund relative to the JSE All Share on a rolling 12-month basis, and you can see that the fund, as the market continues to be quite expensive in 07-08, you see some outperformance but quite marked underperformance over here, which is kind of right for most active funds. They kind of underperformed during this period over here. And then as the market kind of corrects or the market continues to sell down, you see a major outperformance for the fund on this side over here. And then interesting, we start seeing an underperformance here for the fund as the market continues to revert and revert and revert. And then we see as the market continues to be kind of expensive and we no longer have this very, very cheap market on the downside over here, we see the market kind of producing returns that are quite similar to the benchmark, if not slightly worse than the benchmark. But maybe Roland can take us a little bit through some of the risk measures on this fund.
Okay, Roland, so risk in terms of the fund. We're also looking at volatility slightly lower than what we've seen on the JSE All Share.
Yeah, on the fact sheet here, we're seeing that the annualized volatility is about 17% per annum for the fund, and the benchmark is at about 19%. But to a person like me, that doesn't say much, because yes, the benchmark is more volatile than the fund, but the benchmark is very concentrated. The All Share Index has got 10 stocks. The biggest 10 stocks make up 50% of the All Share Index. This fund has got
skewed to the resource space.
Exactly. So if this fund is not as concentrated as the All Share Index, then there are many funds that will have a lower risk, right? There are 88 stocks in this fund, so it is a very well-diversified fund. Now, what I would like to know is if I picked a random 88 stock portfolio, what my risks would be, and compare that to what the fund is. So I'd like to dig a bit more into this. But if we look at some of the other stats here, the maximum drawdown, in other words, the longest and deepest loss period over the history of this fund was 31%. I presume that was in the recent sort of meltdown. And the benchmark, again, lost 45%. So the fund was didn't lose as much as the benchmark during the crisis, but that could again be a small cap effect, in the sense that if the fund has got more small caps don't collapse as much as the large caps during a crash. So naturally, any fund with a small cap bias will have a lower drawdown. And
if you look at sector allocation and also the top 10 shareholdings, I mean, we see the usual suspects: Sasol, British American Tobacco, SAB Miller, Remgro. Interesting that they've got AngloGold Ashanti in that space as well, and of course a bit of the financial Standard Bank and Sanlam.
Well, what is interesting about this fund is that the financial weightings, in other words, Standard Bank and Sanlam are obviously two shares in the top 10 here, but this fund has got a very low financial exposure, and financials are currently, relative to resources and industrials, quite cheap, but certainly coming up on a lot of value radar screens, the financial stocks like the banks, and this fund is underweight though, so it'll be interesting to see how the fund performs given what financials are going to do, because they've taken a big bet against financials.
Absolutely. Okay, so let's look at the overall risk scenarios, and we've extrapolated some of the bigger elements when it comes to market risk and specific and systemic risks. Let's wrap it up, and looking at, in light of this fund as well, we know that Allan Gray is deemed as one of those asset managers that try and offer the clients as little risk as possible with the highest returns.
Look, for me, I think the biggest thing that you want to pay an asset manager for at the end of the day is the ability to decide if you should be in the market or not in the market. It should be the job of an asset allocator. And therefore, for me, I would want to see more managers managing what we call flexible mandates. So managers deciding, look, I want to be in stocks or I don't want to be in stocks because there's something that's worrying me about the market. And there would be people that are good at that, and there's people that invariably won't be good at that. But then you're paying somebody for the benefit of actually deciding for you from an asset allocation perspective if you should or you shouldn't be. Otherwise, if you're just going to own stocks for the long term and you're just going to continue just to own all bonds or whatever, well, then you must be happy with what we call beta risk. You must be happy just to own what the market is prepared to give you. And if there is this extraneous event that's going to happen, well, take your medicine with it and kind of continue.
When you hold an equity fund and clearly you need to diversify and get into other funds, what is your advice out there? Do you think that you should be buying into a balanced fund that's got equities, cash, diversified across all emerging markets, multi-manager fund portfolio? What is the next step forward?
When it comes to getting the maximum return for the given level of risk that you are willing to accept, absolutely, you need to diversify across asset classes, and that's what balanced funds do. But in the South African market, if you diversify across 2 or 3 large stock picking managers or 2 or 3 large balanced fund managers, you're not getting that much diversification because the market is so small. I mean, if Allan Gray holds 88% and I go and buy another fund that holds 88%, I'll see the same shares in the fund, in both funds, right? So I'm not getting the diversification I think I'm getting.
What do you do then?
Well, you literally, in the long run, probably don't need more than 1 or 2 managers. 2 is probably a good sort of number, and after that, you're just paying higher fees for getting the market, right?